Hi, it's the 31st of October and welcome to our 5-minute tax update, which for this month will cover local and international developments for October of 2019. Let's have a closer look at these developments. The Tax Department has finally published the 2018 Corporate Income Tax Return TD4. The updated return includes a new section in Part 3 under the computation of taxable income. Taxpayers involved in intergroup financing are asked to confirm whether a transfer pricing study has been prepared to support the taxpayer's position or whether the taxpayer has followed the safe harbor rules as mentioned in the relevant tax circular issued back in 2017. Taxpayers are reminded that based on the current provisions of the law, the 2018 income tax return should be filed electronically not later than the 31st of March 2020. Failure to submit the return by the due date is subject to a penalty of €100. In the light of the above, those of you that are affected by this should contact immediately your Deloitte transfer pricing advisor, who can advise you on the next steps in order to comply with this new requirement. In a recent announcement, the Tax Department announced that the Council Directive for Administrative Cooperation regarding tax intermediaries, known as DAC 6, will be transposed into national law by the end of 2019. In fact, the relevant draft law has been placed in public consultation from the 21st of October until the 12th of November 2019. Once again, we welcome the initiative of the Tax Department on the adoption of public consultation procedures, and we hope that this is taken advantage by the various stakeholders who should submit their comments to the Ministry. As a reminder, the directive implements the recommendations of Action 12 of the BEPS Action Plan and is designed to increase transparency and prevent aggressive cross-border tax planning. Once the law is voted, information on reportable cross-border arrangements made between the 25th of June 2018 and the 30th of June 2020 should be reported by the 31st of August 2020. The key reporting dates for this directive are shown in the table. Finally, on the local developments, the Council of Ministers has recently approved the relevant tax bills which aim to strengthen the government's tax collecting capabilities and combat tax evasion. The bills include the obligation of all service providers and merchants to accept payments through credit cards and the compulsory submission of income tax returns by all citizens irrespective of their level of income. These topics have been covered in our previous webcast, so we will come back to this once the bills are voted into law. Let's now move on to some international developments. An interesting case examining the concept of beneficial ownership in relation to interest income earned by separate company came before the Mumbai Tax Tribunal. Despite arguments of the Indian tax authorities to the contrary, the Tax Tribunal held that the Cyprus company was the beneficial owner of the income and therefore eligible to claim the lower tax rate under the Cyprus-India Tax Treaty. The significance of this judgment lies on the fact that it is the first judicial ruling on an issue of beneficial ownership of interest income from a tax treaty standpoint. In this decision, the tribunal set down the following key criteria in establishing beneficial ownership. There should be exclusive possession and control over the interest income received. There should be no requirement to seek approval or obtain consent from any entity for making investments, and the recipient of the interest income should have freedom to utilize the interest income unconstrained by any contractual, legal, or economic arrangements with any other third parties. The Ministry of Finance has put forward a harmonization bill for establishing a dispute mechanism between member states for the elimination of double taxation. This was brought about as a result of the 2019 income tax regulations for dispute resolutions within the European Union. The aim is to provide Cyprus tax residents with an appeal channel for assessing situations where there is uncertainty as to whether the right amount of tax was paid for overseas source of income. The bill is currently at the legislative review stage, and there are pressures for its completion as the deadline for the establishing of the harmonization rules was back in July 2019. We will now have a quick look at some tax treaty developments. A new tax treaty was signed between Cyprus and Egypt, which was published in the Gazette on the 18th of October 2019. The provisions will come into effect as of the 1st of January 2020 and would replace the provisions of the existing tax treaty that was in effect since 1996. According to the new tax treaty, eligible Cyprus tax residents earning income sourced from Egypt can enjoy reduced withholding tax rates as follows: 5% withholding tax on dividends if the beneficial owner is a company other than a partnership which holds directly at least 20% of the capital of the company paying the dividend throughout a period of 365 days. A 10% withholding tax will apply in all other cases. There is also a 10% withholding tax on interest and royalties, provided that the recipient is the beneficial owner of the income. Cyprus has also signed a new tax treaty with the Netherlands, but this has yet to be published in the Gazette. Watch this space for an update once this is published. Finishing off with our tax diary, there are no deadlines for the 31st of October or the 30th of November. So this concludes our tax update for this month. Thank you for watching.